What's better than buying a house? Buying 1,000 houses? In this video, we will compare real estate versus stocks and try to answer which is a better investment. Stay until the end because the answer may surprise you. We will be comparing these four main categories: risk, return, effort, and long-term growth. Let's start with risk. What is the chance that you lose money? But in general, it's easier to lose money in the stock market than in real estate. So real estate wins this round. With real estate, there are many different ways to invest. If you want to keep things simple, you could just buy a low-cost index fund that tracks the entire stock market. Historically, the S&P 500 has returned around 10.5% annually. If you add dividends back in, the number increases to 14%. But keep in mind, past performance is not indicative of future returns. First, you can make money through capital gains. If you buy a stock for $100 and sell it for $120, you made $20. And second, you can make money through dividends. Some companies pay their shareholders a portion of their profits. This is usually done on a quarterly basis. At the same time, you're still going to be paying your mortgage. Well, that depends on how much risk you're willing to take. Generally speaking, real estate requires a lot more work than stocks. You have to find a property, make an offer, negotiate with the seller, finance the property, manage tenants, repair the property, pay for maintenance, and the list goes on. Stocks have the potential to make you a lot of money very quickly, but that also means that you can lose money just as fast. If you like working on projects and fixing things up, then real estate might be a better option. But if you prefer a more hands-off approach, then stocks are the way to go. Real estate, on the other hand, is slower moving. The Dow Jones Industrial Average was at $66 when it started in 1928. Today it's at around $30,000. That's around a 4,500 increase. So it really comes down to your tolerance for risk. However, the stock market has not always gone up. But if you're willing to accept lower returns for more stability, then real estate is the way to go. During the Great Depression, the Dow Jones dropped by 89%. And during the dot-com bubble, it dropped by 78%. But hopefully this video gives you something to think about. If you're looking for the fastest possible growth, then stocks might be a better option. But if you're willing to accept lower returns for more stability, then real estate is the way to go. And real estate prices have grown faster than inflation since the 1920s. However, that doesn't mean that real estate always goes up. There are periods of time where real estate prices drop. It will take you years to build wealth, but it's also less likely that you'll lose money. If you had invested in the stock market during those same periods, you would have made more money. But over the long run, real estate has outperformed the stock market. All you need to do is open up a brokerage account, deposit money, and then buy some shares. For example, you could buy a low-cost index fund that tracks the entire stock market and invest in real estate on the side. This way you get the benefits of both investments. Once you've done that, you can sit back and collect dividends while the stock grows in value. So you could be underwater on your investment. That's why it's important to only buy a property that you can afford to pay for in cash. They see people making millions of dollars on YouTube, and they think that they have to make that kind of money, or else they're not doing well. If you want to get rich quick, stocks might be a better option. But if you're happy with slow and steady growth, then real estate is the way to go. But that's not really true. For most people, a 7% return is pretty good. That means if you invest $10,000 into the stock market every year, you should be able to retire with around $1 million. If the property drops in value, you don't want to be in a position where you have to sell at a loss because you need to pay your mortgage. You can buy and hold a property for long-term rental income, or you can buy a property and flip it. According to the National Association of Realtors, the average rental rate for a single-family home in the U.S. is around 10. On top of that, you can benefit from leverage. In this case, the property requires little work, but you have to be willing to sacrifice the rental income for the flexibility. Similarly, you can buy a stock that pays a high dividend yield, but that requires a lot of research. For example, if you wanted to invest in real estate, you would have to research the market, find a property, make an offer, and so on. But if you invest in a high dividend stock like a TNT, you won't have to do anything except monitor the stock price and collect dividends. When you finance a property with a mortgage, you only need to put down a small percentage of the purchase price. For example, if you put 20% down on a $300,000 house, you would only need $60,000. The rest of the money is borrowed from the bank. By doing this, you can make a higher return on your investment. For example, if you make $20,000 a year renting out the house, that would be a $333 return on your investment. That means if you buy a $300,000 house and rent it out for $2,500 per month, you would get a 10 annual return. Now, of course, this is just an example, and actual returns will depend on many factors like location, property taxes, insurance, maintenance costs, and vacancy rates. Also, you have to factor in the opportunity cost of having your money tied up in a property that you Q&T invest elsewhere. So depending on your strategy, real estate returns can vary widely. You can invest in REITs or in a real estate business. All of these strategies have varying levels of risk. But generally speaking, when it comes to investing in properties as an individual, it is considered to be less risky than the stock market. Real estate has historically appreciated at an average of around 3% per year. So even if you bought at the peak of a market cycle, it would take decades for your investment to drop by 50%. Of course, this does not mean that there's no risk involved. There are plenty of examples of landlords who lost money when they bought properties at the peak of the market and interest rates went up. There are also other risks like natural disasters, economic downturns, or just being unlucky enough to get a bad tenant. But all of these risks can be mitigated. Compared to real estate, the stock market is much more volatile. A diversified stock portfolio can reduce your risk of losing money, but it is still possible. And unlike real estate, you cannot physically inspect a stock to see if it's any good. Stocks are worth what people think they are worth. So the stock market is affected by people's perception of the future, and that can be very unpredictable. Because of that, it is easier to lose 50% of your money in the stock market than it is in real estate. The highest ever recorded annual loss for the S&P 500 was negative 43.3%. However, if you had held on to your investments for long enough, you would have made money. For example, since 1950, the average bear market drop has been around 30%, and the average bull market gain has been 158%. This shows that even though the stock market can be quite volatile in the short term, if you ignore the noise and stay invested, you will make money over time. So, when it comes to risk, both real estate and stocks have their pros and cons. Next, let's talk about return. Now let's compare that to real estate. If you do your research and find a great deal on a property in a good area, you could make a lot of money. However, leverage also works against you. If the housing market drops, your property value could go down. When it comes to stocks, there are two ways to make money. Which one is better? Let's compare this to stocks. It's common for new investors to look at the returns of the stock market and get discouraged. So which one is better? That depends on your goals. Now let's talk about effort. How much work is required to make money? On the other hand, stocks are much easier to manage. There are some exceptions though. For example, some people buy a property and then leave it vacant so they can use it as a vacation home. So which one is better? Well, that depends on your preferences. Next, let's talk about long-term growth. Which one has the best growth potential? In fact, according to a study by Robert J. Schiller, there have been 7 major housing bubbles since 1889. Stocks have grown tremendously over the last 100 years. The bottom line is that real estate and stocks both have the potential for high returns over the long term, but they also both have periods of time where prices drop. So which one is better? Well, that depends on your goals. If you're looking for the fastest possible growth, then stocks might be a better option. So which one is better? Well, it really comes down to your personal circumstances. It's also worth noting that you don't have to choose one or the other. You can invest in both stocks and real estate. Ultimately, the decision of whether to invest in real estate or stocks is up to you. There's no right or wrong answer.